AI tools every smart investor is using in 2026. If you're still investing the way people did 5 years ago, you're already behind. In 2026, the stock market is no longer driven purely by human intuition, analyst reports, or quarterly earnings calls. It's powered by algorithms. Machine learning systems scan millions of data points every second. Institutional traders deploy AI that reacts in milliseconds. Hedge funds rely on predictive modeling that adapts in real time. The smartest investors are no longer just reading charts, they're using AI. But here's the surprising part. Many of these tools are no longer exclusive to Wall Street. Retail investors now have access to AI-powered platforms that were once reserved for billion-dollar funds. The question isn't whether AI is influencing the market. The question is, are you using the same tools smart investors are using in 2026? Let's break down the 7 AI tools quietly reshaping how serious investors make decisions. 1. AI stock screeners that go beyond basic filters. Traditional stock screeners filter by price-to-earnings ratios, market cap, revenue growth, or dividend yield. AI-powered screeners go much further. Instead of static filters, these systems analyze patterns across thousands of variables simultaneously. Earnings momentum, macroeconomic shifts, sector rotation trends, options flow, insider transactions, and volatility regimes. Platforms like Kavoot use machine learning scoring systems to rank stocks based on predictive models. Rather than simply showing undervalued companies, they assign probability-based performance ratings. What makes this powerful is dynamic learning. As new data enters the market, the system updates its scoring models automatically. It adapts to changing conditions instead of relying on outdated formulas. Smart investors use AI screeners not to blindly follow signals, but to narrow opportunity fields faster and more intelligently. Speed plus probability equals advantage. 2. AI earnings call analyzers. Earnings season moves markets fast. By the time a human finishes reading a transcript, institutional algorithms have already reacted. AI earnings analyzers use natural language processing to evaluate tone, sentiment shifts, guidance changes, and keyword frequency within seconds. For example, tools powered by technology from companies like AlphaSense scan earnings transcripts, SEC filings, and conference calls instantly. They flag subtle language changes, cautious wording, reduced forward confidence, margin pressure hints. Even minor shifts in executive tone can precede stock volatility. Smart investors use these tools to detect sentiment changes early, compare language against previous quarters, and spot inconsistencies before the broader market reacts. In 2026, information speed matters more than ever. 3. AI sentiment monitoring platforms. Markets move on emotion as much as fundamentals. AI sentiment tools track millions of data points from financial news, analyst reports, blogs, and social discussions. They quantify optimism, fear, uncertainty, and momentum acceleration. Platforms like MarketPsych convert emotional signals into numerical indicators. For instance, if social buzz around a stock spikes dramatically while sentiment shifts negative, AI systems detect potential volatility before price charts reflect it. This doesn't mean blindly following online hype. It means measuring crowd psychology with data rather than guesswork. 4. AI portfolio optimization engines. Diversification used to mean spreading capital across sectors and asset classes. Now, AI optimizes portfolios dynamically. Tools like BlackRock's Aladdin system institutionally analyze correlations, macroeconomic risks, liquidity exposure, and stress test portfolios across thousands of simulated scenarios. While retail investors don't access Aladdin directly, modern robo-advisors and AI-powered platforms use similar optimization principles. These systems rebalance portfolios automatically when volatility spikes, correlations shift, or macroeconomic indicators change. Instead of reacting emotionally during downturns, AI recalibrates based on probability modeling. Smart investors use AI optimization to reduce drawdowns and maintain disciplined risk exposure, because protecting capital is just as important as growing it. 5. AI options flow and unusual activity trackers. Options markets often reveal where sophisticated money is positioning. AI tools now scan unusual options activity in real time, identifying abnormal volume spikes, large block trades, and volatility mispricing. Platforms such as Unusual Whales use machine learning to filter noise from meaningful signals. Rather than manually scanning options chains, investors receive alerts when statistically significant positioning appears. For example, if large call options appear suddenly in a stock with rising sentiment and improving fundamentals, AI highlights the convergence. This doesn't guarantee outcomes, but it increases informational awareness. Smart investors treat options flow as a supplementary signal. 6. Alternative data aggregators. Traditional investors relied heavily on quarterly reports. AI-driven alternative data platforms now provide near real-time insights. These include satellite imagery tracking retail parking lot traffic, shipping and supply chain data, web traffic and app download metrics, consumer spending patterns, job posting trends. Companies like Thinknum aggregate unconventional data sources and use AI to identify predictive relationships. If online traffic surges for a company weeks before earnings, AI detects that trend early. If hiring freezes appear across a sector, that may signal margin compression ahead. Alternative data provides an informational edge beyond standard financial statements. In competitive markets, edge matters. 7. AI predictive trading models. The most advanced AI tools use machine learning to forecast probability ranges for price movement. These systems don't predict exact prices. They estimate risk-adjusted directional bias. Hedge funds and quant firms have used this for years. Now, scaled-down versions are accessible to independent investors. Some platforms incorporate reinforcement learning models that adapt as markets evolve. Others combine technical indicators with macroeconomic modeling. For example, institutional firms like Renaissance Technologies pioneered data-driven algorithmic trading long before retail access expanded. While retail tools are not as sophisticated, they follow similar frameworks. The key advantage is consistency. AI models remove emotional interference. They operate on probabilities, not panic. Why smart investors don't rely on just one tool. Here's what separates experienced investors from beginners. They stack tools. An AI screener identifies opportunities. Sentiment analysis confirms emotional positioning. Options flow highlights institutional activity. Portfolio optimization manages risk. Alternative data strengthens conviction. Each tool provides a layer of confirmation. Individually, signals may fail. Combined, probabilities improve. The goal is not perfection. The goal is informed decision-making. The risk of over-reliance. There's a danger, however. AI tools are powerful, but they are not infallible. The smartest investors in 2026 are not gambling on hype. They are using AI to process information faster, detect patterns earlier, manage risk more intelligently, reduce emotional decision-making, optimize portfolios dynamically. AI does not eliminate uncertainty, but it reduces blind spots. And in markets, reducing blind spots can dramatically improve long-term outcomes. The future of investing is not human versus machine. It is human plus machine. If you're serious about growing capital in this new era, the question isn't whether AI will shape markets. It already is. The real question is whether you're using the tools that smart investors are quietly relying on right now.